Money is supposed to be boring, silent, administrative, invisible. When money works, you're not supposed to notice it at all. But history shows something strange. The most dangerous moments in a nation's life are not when money disappears. They're when money stops moving. Imagine a country where the government refuses to trust banks, where tax money is not deposited, not invested, not multiplied. Instead, it is locked away behind iron doors, untouchable, motionless, safe. Now imagine what happens when everything outside those doors catches fire. This is the story of the moment the United States tried to separate money from power and discovered that purity comes with a price. Today, the American financial system runs on an arrangement most people never question. You pay taxes. That money flows into private banks. Banks lend it, invest it, and profit from it. When those bets fail, the government steps in to stabilize the system. Losses are shared. Gains remain private. We call this normal, necessary, inevitable. But for a long time, Americans believed it was dangerous. And for nearly 70 years, the United States tried something radically different. No government deposits, no government lending, no trust in Wall Street. The federal government would hold its own money and only its own money. This experiment had a name, the Independent Treasury, and it was born from betrayal. To understand why the United States made such an extreme choice, you have to go back to the early 19th century, a time when America's financial system sat on a contradiction. Banks were private institutions, but the power they held was public. They stored government money, issued paper currency backed by it, and used that leverage to speculate across the economy. When those banks succeeded, profits flowed upward. When they failed, the damage spread everywhere. This system reached its breaking point in the 1830s. President Andrew Jackson believed the center of the problem was the Second Bank of the United States, a powerful national bank that blended politics, finance, and influence into one institution. To Jackson, the bank was not stabilizing the economy. It was controlling it. He destroyed it. Many Americans celebrated. They believed the monster was dead. But Jackson made a fatal mistake. The government's money didn't vanish. It was simply moved. Federal deposits were transferred into state-chartered private banks, institutions later nicknamed pet banks. Suddenly, these banks found themselves holding massive amounts of government gold and silver. And like any financial system fueled by confidence and opportunity, they did what banks always do. They multiplied it. Gold became reserves. Reserves became paper. Paper flooded the economy. Land prices exploded. Cotton prices soared. Speculation replaced production. For a moment, it felt like prosperity. Then, in 1837, the illusion collapsed. Banks failed by the hundreds. Paper money lost credibility. Depositors demanded gold that no longer existed. And buried beneath the wreckage was a horrifying realization. The federal government's money was gone. Not stolen, not spent, trapped. Locked inside the vaults of failed banks that had simply stopped operating, the United States government was technically bankrupt, not because it lacked wealth, but because it could not reach it. This was the crisis inherited by President Martin Van Buren, and it forced him to confront a question no government wants to ask. What happens when the state depends on institutions driven by profit, panic, and speculation? Van Buren's answer shocked the financial world.
Public money should be held by public servants, not banks, not lenders, not speculators. The government would never again allow its survival to depend on private balance sheets. From this idea came the independent Treasury. Its design was brutally simple. The federal government would collect taxes only in hard money, gold and silver coin. That money would be stored in vaults owned by the government, operated by government clerks, and protected by stone, iron, and law. When the government needed to spend, it would open the vault and pay directly. No deposits, no loans, no interest, no paper promises. Money would only move when the government decided to move it. This was not innovation, it was regression, a return to something almost medieval in a world racing toward industrial finance. Supporters believed this was its greatest strength, a system too simple to corrupt, too rigid to gamble with, immune to bank runs. The government would be safe no matter what happened to banks. Critics saw something else. They saw hoarding. They saw stagnation. They warned that locking money away would starve the economy of liquidity, that capital must circulate or commerce would suffocate. Supporters replied with a colder logic. Dead money is better than stolen money. The political battle was vicious and lasted years. But in 1846, the Independent Treasury Act was finally signed into permanent law. Almost immediately, the physical landscape of American finance changed. Across major cities, massive stone buildings began to rise, windowless, fortress-like, uninviting. These were not banks. They did not lend. They did not advertise. They did not smile. They guarded. Gold and silver flowed into these vaults from tariffs, land sales, and taxes. Clerks weighed coins, tested purity, recorded every ounce. Then the doors closed. For the first time in American history, the federal government stood completely apart from the banking system. No entanglement, no dependency, no safety net for anyone but itself. And at first, it worked. When war broke out with Mexico, the government didn't borrow, it didn't negotiate, it opened the vault. The money was there. The experiment appeared vindicated, but beneath the surface, something dangerous was forming. The independent Treasury was safe, too safe, and soon the economy would learn what happens when money refuses to move. The problem with systems designed for purity is not that they are immoral, it's that they are inflexible. The independent Treasury was never built to manage an economy. It was built to protect the government from banks. And for a while, those goals looked compatible. America was growing. Gold was flowing in. Trade was expanding. But economies don't move in straight lines. They breathe, they expand, they contract, they surge forward and then pull back. And the independent Treasury did not know how to breathe. At first, the flaw was invisible. The system did exactly what it was designed to do. When the economy was strong, Americans imported more goods. Imports meant tariffs. Tariffs meant gold. Every ship that docked brought sacks of coin to government vaults, and every sack was locked away. At the exact moment the economy needed more money to support trade, wages, and expansion, the Treasury was quietly removing it from circulation. Gold flowed inward and then stopped. Merchants felt it first. Coin became harder to find. Payments slowed. Credit tightened. But the government saw nothing wrong. Its vaults were full. Then came the other side of the cycle. When trade slowed, imports dropped. Tariff revenue collapsed. Gold stopped flowing into the vaults. But government spending didn't stop. Soldiers still needed pay. Suppliers still needed payment. Operations continued. So the Treasury did the only thing it could. It spent its reserves. Gold flowed back into the economy, not because confidence returned, but because fear had already arrived. Money surged outward at the worst possible moment. Later, economists would give this behavior a technical name, pro-cyclical, but merchants gave it a simpler one, strangulation. The Treasury had become a giant vacuum cleaner. It sucked money out when it shouldn't and dumped it back when no one wanted to touch it. And because the law strictly forbade depositing government funds in banks, there was no way to soften the impact, no adjustments, no fine-tuning, no emergency response. The Secretary of the Treasury could only watch. From Washington, he saw gold stacking higher and higher inside vaults. Outside those walls, shopkeepers failed because they couldn't find enough coin to settle accounts. The government was solvent. The people were not. The separation of bank and state was complete and painfully cold. For years, the tension simmered quietly. Most Americans didn't understand the mechanics. They only felt the symptoms. Money felt tight when business was strong and oddly loose when fear was everywhere. Then, in 1857, the system met its first true test, and it cracked. The panic of 1857 was not a local downturn. It was the first truly global financial crisis. Railroad companies collapsed, factories shut down, international trade seized up, banks stopped lending, credit vanished, confidence evaporated almost overnight. And when fear spreads, people do the same thing in every century. They demand real money, gold. Banks, already strained, faced impossible pressure. Depositors lined up, vaults emptied, lending stopped entirely. Businesses didn't fail because they were unproductive. They failed because they were illiquid. And sitting quietly in Lower Manhattan, behind granite walls and iron doors, was the one thing that could have slowed the collapse: government gold. The New York Sub-Treasury vaults were overflowing. The federal government had run a surplus.
Millions of dollars in gold coin sat stacked, weighed, and sealed. The lifeblood of the economy was locked away, a few streets from the panic itself. But the law was absolute. The independent Treasury was forbidden from releasing money into the banking system. Officials could see the crisis. They could hear it. They could feel it. And they could do nothing. It was like watching a city burn while standing beside a locked reservoir. Public outrage exploded. Merchants accused the government of hoarding wealth while the nation suffocated. Newspapers called the system heartless. Bankers warned that the separation of bank and state had become a murder-suicide pact. The pressure became unbearable, and finally the Treasury Secretary broke the spirit, if not the letter, of the law. Unable to deposit funds into banks, he improvised. He began buying back government bonds early. Gold flowed to bondholders, not because it was efficient, but because it was legal. The goal wasn't investment, it was circulation. It was a crude maneuver, slow, awkward, and imprecise. But it worked, barely. The panic eased, the economy survived, and the independent Treasury lived to see another day. But something essential had been lost: the illusion. The system had not failed because of corruption. It had failed because it could not adapt. It could not tell the difference between prosperity and panic. It treated both exactly the same. And that weakness would return, far more violently. Just 4 years later, the United States faced a crisis that no vault could contain: civil war. The independent Treasury had been designed for peace, for predictable revenue, for manageable expenses, for routine governance. War shattered every assumption. The cost of the Civil War was staggering: millions of dollars per day. Weapons, soldiers, railroads, logistics on an industrial scale. And the law still demanded payment in gold. There wasn't enough. At first, the Treasury tried to follow the rules. It pressured New York banks to lend gold to the government. Patriotism held, briefly.
But as Union defeats mounted, confidence collapsed. Banks faced an impossible choice: give their gold to the government and risk collapse, or protect themselves and abandon the system. In December of 1861, they chose survival. Banks suspended specie payments. Paper money could no longer be exchanged for gold. The foundation of the independent treasury was gone. The government could not demand gold from banks that no longer had it. It could not demand gold from citizens who never saw it. The law still existed. Reality did not care. To survive, the Treasury did the one thing the independent Treasury had been designed to prevent. It embraced paper money. In 1862, the Legal Tender Act created a new kind of currency: greenbacks, money backed not by metal, but by the authority of the government itself. The vaults built to protect gold and silver filled with ink and paper. The experiment was no longer pure. The independent treasury had become something else entirely, a war machine, and once that door was opened, it would never fully close again.
The Civil War ended. The cannons fell silent. The armies disbanded. The nation began to rebuild. But the independent treasury did not disappear. That's the part most people never learn. The system had been philosophically broken by necessity. Hard money had failed under the pressure of war. Paper currency had flooded the economy. By all logic, the independent treasury should have died in 1865. Instead, it lingered. Because institutions do not vanish when their purpose collapses. They survive on inertia. The vaults were still there. The clerks were still there. The law separating government money from banks was still on the books. On paper, nothing had changed. In reality, everything had. America emerged from the war as a different country. Industrial, national, interconnected. Railroads stitched the continent together. Markets expanded beyond cities into entire regions. Capital moved faster than ever before. And money, real money, mattered more than gold sitting still. Paper currency was now a permanent feature of American life. Gold still anchored confidence, but it no longer ruled alone. Yet the independent treasury remained trapped in a world that no longer existed. It was a 19th century machine operating inside a modernizing economy. And that mismatch created a new danger: improvisation. As financial crises became more frequent in the late 19th century, attention always turned to the same place: the Treasury. The Secretary of the Treasury sat atop enormous reserves of cash. When banks struggled, when markets tightened, when confidence wavered, there was one obvious question: would the government step in? Officially, it wasn't allowed. Unofficially, it often did. Gradually, quietly, Treasury secretaries began bending the rules, not because they wanted power, but because the alternative was collapse. They couldn't legally operate as a central bank, but they could cheat just enough to keep the system alive. When farmers needed cash to move crops, the Treasury deposited government funds into selected national banks. Liquidity increased. When speculation overheated markets, the Treasury pulled money back into the vaults. Liquidity disappeared. There were no formulas, no mandates, no clear authority, just judgment. One man in Washington deciding when to open the vault and when to lock it. The United States had accidentally created a shadow central bank, but without the tools to run one. No formal lender of last resort authority, no ability to issue currency on demand, no direct control over interest rates. Just a blunt instrument. Add money, remove money. It was like trying to stabilize an aircraft by opening and closing the cargo door mid-flight. Sometimes it worked, often it didn't. Every year the same pattern returned. Autumn, harvest season. Farmers needed cash to move crops.
Railroads needed liquidity. Merchants needed credit. The economy leaned forward, waiting. Would the Treasury act in time? If the Secretary hesitated, money tightened. If he acted too aggressively, speculation surged. Entire markets began to revolve around guesses about what one official might do next. The health of the national economy rested on timing, instinct, and political courage. This was not stability. It was roulette.
Despite these flaws, the system staggered forward for decades. America grew richer, industry expanded, global influence increased, and many people mistook survival for success. But beneath the surface, the structure was rotting. Financial panics did not disappear, they multiplied, each one more severe than the last, each one exposing the same weakness. The independent Treasury could protect government money, but it could not protect the economy. By the early 20th century, the cracks were impossible to ignore. Trust companies, lightly regulated financial institutions, had grown rapidly. They operated outside traditional banking rules, but were deeply intertwined with markets. They held deposits, they made loans, they took risks, and they were vulnerable. In 1907, confidence in one trust company collapsed. That fear spread fast. Depositors rushed to withdraw funds. Trust companies failed. Banks panicked. The stock market plunged. The panic of 1907 was not subtle. It was violent. Markets fell by half. Banks across the country suspended operations. Credit vanished. Once again, fear demanded liquidity. And once again, attention turned to the Treasury. The government had money, plenty of it, but having money was no longer enough. The Treasury Secretary released millions into the banking system. He tried to stop the bleeding, but the independent Treasury moved too slowly. Funds could not be targeted precisely. Support could not be applied where panic was hottest. The tools were too blunt, the mechanisms too rigid. The fire spread faster than the government could respond. And so, for the second time in half a century, the United States faced a humiliating truth. The government could not save its own financial system. That job fell to a private citizen, J.P. Morgan. Morgan gathered the leading financiers of New York. He locked them inside his library, and he forced them to act. Private capital was pooled. Resources were coordinated. Rescues were executed. The panic subsided. The country survived. But the message was devastating. The world's largest industrial power had been saved not by its government, but by one aging banker with authority no law had granted him. The independent Treasury stood exposed. It could guard money, but it could not manage panic. It could preserve reserves, but it could not deploy them with speed, precision, or force. The system had outlived its usefulness, and now everyone knew it. The question was no longer whether the divorce between bank and state had failed. It was what would replace it. The panic of 1907 became the final verdict. Purity had lost. Flexibility had won. But flexibility would come with a price, and the next system would bind banks and government together more tightly than ever before. The panic of 1907 did something no argument ever could. It settled the debate. For decades, Americans had argued about purity versus flexibility, safety versus growth, locked vaults versus flowing credit. 1907 made the answer unavoidable. A modern economy could not survive with money trapped behind iron doors. Something had to change. In the aftermath of the crisis, politicians, bankers, and economists reached the same conclusion from different directions. The United States needed a system that could hold reserves, issue currency, lend freely during panic, and act quickly without improvisation. Everything the independent Treasury was designed not to do. The divorce between bank and state had gone too far. The question was no longer whether to remarry, it was how. In 1910, a small group of powerful men met in secret.
They traveled under false names, avoided reporters, and gathered at a private resort off the coast of Georgia. Their goal was not conspiracy. It was survival.
They were designing a system that could prevent another 1907. A permanent institution that could coordinate reserves, stabilize markets, and act as lender of last resort. 3 years later, their work became law. In 1913, the Federal Reserve Act was passed. The Federal Reserve was the complete inversion of the independent Treasury. Instead of locking money away, it centralized reserves. Instead of refusing to lend, it existed to lend during crisis. Instead of rigid rules, it was built on discretion. The marriage between bank and state was officially restored, and this time it was formal. But the independent Treasury did not disappear overnight. For 7 awkward years, the old and new systems coexisted. Sub-Treasury vaults still held gold. Government clerks still guarded it. The Treasury hesitated to fully trust the new institution. Old habits die slowly. Finally, in 1920, Congress made the break official. The independent Treasury was abolished. The vaults were opened. The gold was transferred. The clerks were reassigned or dismissed. The iron doors closed for the last time, quietly, without ceremony, without apology. Most Americans barely noticed. There was no funeral, no national reckoning. The independent Treasury vanished into history, absorbed by a system that promised stability through flexibility. Money no longer sat still, it flowed. For a long time, that choice seemed justified. The Federal Reserve could inject liquidity during panics. Banks could expand credit. The economy could grow faster than gold ever allowed. Industrial power exploded. Global influence expanded. America became the financial center of the world. But every solution carries a shadow. Flexibility came with a cost. Money could now be created faster than value. Risk could be postponed instead of eliminated. Losses could be delayed and transferred. Over time, something familiar returned. The government and the banks were no longer just married, they were inseparable. Banks held government debt. The government insured bank deposits. When banks failed, they were rescued. When markets panicked, money appeared. The cycle the independent Treasury tried to escape came back, larger, more complex, and harder to see. Then came 2008. Banks gambled, banks collapsed, and the government stepped in. Trillions were created, balance sheets exploded, moral hazard became policy. The system survived, trust did not, and in the wreckage an old instinct resurfaced. What if money didn't move unless you moved it? What if wealth didn't depend on counterparties? What if safety meant stillness? That question didn't come from historians or economists, it came from programmers. Bitcoin didn't invent distrust of banks, it inherited it. Strip away the code and the philosophy is ancient. It is the same instinct that built the independent Treasury. Counterparty risk. When someone moves assets off an exchange and into cold storage, they are reenacting a 19th century argument with 21st century tools. I don't trust you to hold this. I'll guard it myself. The iron vault has become a cryptographic key. But history offers a warning. The independent Treasury did not fail because it was corrupt. It failed because it was rigid.
Because it could not expand when expansion was needed. Because it could not lend when panic demanded it. Pure systems are brittle. Elastic systems are dangerous. Every society must choose where it wants to break. Today, that choice is returning under a new name: central bank digital currencies. A CBDC promises direct accounts with the central bank, no intermediaries, no commercial banks in between. In theory, every citizen could hold money as safely as the government itself.
a digital independent treasury for everyone. Banks understand exactly what this implies. If citizens can store money without banks, banks lose power. If deposits no longer sit on private balance sheets, lending must change. That is why the arguments from 1846 have returned almost word for word. This will starve the economy of credit. This will slow growth. This will centralize too much power. And the counterargument remains just as cold. Better rigid money than stolen money. Better safety than speed. Better sovereignty than convenience. The independent treasury was clumsy, it was flawed, and it was ultimately abandoned. But it was not foolish. It was a line in the sand, a declaration that public money should not be gambled, that safety matters, that sometimes money should refuse to move. We killed that system because it could not adapt. Then we built one that adapts too easily. And now, trapped between inflation and instability, trust and control, the same debate is back, dressed in new language, powered by new technology, but driven by the same fear. Who holds the vault? Who holds the key? And when the next panic comes, will we choose flexibility again? Or will we try, once more, to lock the door?